US crude has dropped to a new yearly low, but how will the recently imposed price cap affect its price? Hello and welcome back to our channel. My name is Daniela Hathorn, market analyst here at Capital.com. And in today's video, we are going to be looking at the recent price moves in oil markets. So of course, please like this video, comment, subscribe, and turn on your notifications to be kept up to date on all the content we post on our channel. Okay, so there is a lot to talk about oil. It's a very busy market at the moment. So I'm going to try and be as quick as I can, not drag on too much. But as I said, there is a lot of points to mention. Starting off, of course, with that bearish reversal continuing in oil prices since those highs that we saw throughout the summer. We've seen some attempted rebounds over the last 3-4 months. But once again, we are in a bearish pattern. And oil prices, especially WTI US crude, has dropped below its 2022 low. So it is setting a new yearly low in today's session. Now, fundamentally, as I said, there is a lot of things to mention. So let's start off quickly with the most prominent one right now, and that is the EU ban on Russian crude, which is now transformed into the price cap. So just a little bit of a quick recap. The EU came out throughout the summer saying that they were going to ban all seaborne imports of Russian crude. Then the G7, so the group of 7 nations, and also the EU and Australia started these talks about a potential price cap. It wasn't clear if that was going to happen. So the EU did say that unless a price cap was agreed, they were going to completely ban all imports. We saw last Friday on December 2nd, that price cap was actually fully approved at $60 per barrel. So therefore the the EU is no longer banning crude imports. They're just banning any imports above that ban price of $60 per price, and any insurance on crude imports was not permitted above that price. So that is what we have at the moment. It is going to be reviewed every 2 months as long as it stays within a 5% range below the market price. So that may change. It's not a set price cap. It will reflect the moves in the market. Now, how is that impacting prices? How much of an impact is it actually going to have? Well, there's 2 things to consider. One of them, how implementation is going to go. Are countries actually going to stick to the price cap, or are they going to be a little bit lax on it? If we do see a strict implementation, then I do think we have higher pressure on already tight supply, and therefore we could see a strong rise in oil prices. If we have a bit more of a lax implementation and countries are taking it on just as long as it's on and around the price cap, then we may not see as much of a greater impact. And then, of course, secondly, it's all going to depend on Russia's ability to increase their exports to China and India. We know they have been Russia's biggest market throughout the last few months. They have taken a lot of excess supply, but of course, that is also at discounted prices given the situation. So China and India may step up their intake a little bit. So, of course, it's going to depend on that. It's still very early days. It's only been imposed since this Monday, so about 3 trading days now. So that is really what we have. Is it going to be a lax implementation, and how can China or India take on more of that excess if the G7, EU and Australia do start to outstrip their supply? Of course, not only that, but we've had a reply from Russia. Russia saying that they will completely stop selling crude to any countries that adopt this price cap. So, of course, we may see that reply from Russia, and that will have a strong impact on supply. They may just completely cut off their output and seek their other partners like China and India. Again, will that reduce supply in the market? Probably. That will have, again, an upward impact on prices. So those are all things to consider. As I said, it's still very uncertain as to what's going to happen. But that's been keeping the talk about oil prices on the front line. And of course, volatility in the oil market remains to be extremely high. Also, aside from the price caps and the ban on Russian crude, we also have OPEC Plus. They are being very proactive this year, which is unlike them. And that is, of course, to stem what they are saying is a systemic drop in oil prices. We saw last week they actually agreed on Sunday that they were going to keep their output quotas for the remainder of the year. So remember, back in October, we saw them implement a 2 million barrel per day output cut. They did review that. They said said they're going to remain that unchanged. They haven't increased it or decreased it, and that is expected to remain until the end of 2023, and it will be reviewed in February. So OPEC Plus still remains supportive in terms of the supply side, so that is also keeping oil prices a little bit supported in the short term. In terms of Russian crude as well, it's come to light that the actual break-even point of Russian crude, so at which point Russia starts to make money on their exports, is actually below or on and around the $60 price cap. So essentially, actually, it's below. So essentially, Russia will not be losing out on money. They will not be making a loss on exporting their crude to the G7 nations. It will just be limiting their profits from the sale of crude. That is the goal of the G7 nations. As we said, the EU is going to be more strict, impose a complete ban. They were then talked into by the US to adhere to the price cap, which means essentially Russian crude is still allowed to flow through the market, which does reduce the tightness of supply. They're just trying to limit the profits that Russia can make on that. So that is pretty much that. But as I said, Russia actually still makes a profit at that $60 price cap. So if they do decide to go ahead with continuing exporting oil, or Russia continues to export oil to these countries, we may continue to see their profits remain. And also the Russian benchmark, which is actually trading at a discount to Brent, is not that far off from the $60 price cap. So again, the impact on Russian crude, not really that much. It's more the sentiment that we have around oil, and especially if Russia comes back and decides to completely stop their exports to the G7 countries, which will include the UK, the US, and the EU economies. Other things to take into account before we get into the technicals, as I said, there is a lot going on. We do have the Chinese reopening trade as well. Now, oil hasn't actually been that reactive to it. We've seen that weakness in oil remain, even though over the last week or so, we have seen the reopening trade price in. Whether it's a case of the oil market still predicting a slowdown in the growth of demand in developed nations, then that, of course, having an impact throughout the first quarter of the year. Who knows? But of course, keep an eye out for Chinese reopening, because that will have a big impact on oil prices as well if we do see that continue to gather momentum. And one final point on oil is that the SPR repurchase price, so the price at which the US is willing to replenish their strategic petroleum reserves. Remember, we've seen the Biden administration releasing those throughout the year to help with the dramatic increase in prices throughout the first half of the year. They released a lot of it, so therefore they have to replenish that. And the price which the White House has set so far is between $67 and $72 per barrel. We are nearing that price now, so we may actually see some good support coming in at current levels, meaning that the bearish momentum in oil may start to see that resistance to go further. Before we get into the chart, let's quickly take a look at some key levels to keep an eye out. First of all, on the downside, of course, that $72 mark, as I just mentioned, that is the SPR level at which potentially we may start to see that replenishment coming in. So, of course, we're going to see some testing of that area, but keep it in mind. Then we've got the $70 mark, a nice psychological round level, and then 66.50, which is the low from December 20th last year. And then going on to the upside, we've got 79.86, which is the high from November 25th this year. Then we've got around the $80 mark. That is where currently descending trend line resistance is holding. And then 83.26, which is the high from December 1st. Okay, so this is the US crude chart. This time we're on trading view. We've got a nice pattern set up here. And as you can see, we've seen that drop in US crude WTI intensifying once again after finding some resistance. Now, some of you may know, if you've been watching these videos for a while, that I have been following this wave pattern for the last 6-7 months or so. These are the areas marked here. And just roughly as a quick explanation, we've seen these rallies followed by a descending trend that has been capped by an upside, descending line. And then we've seen a runaway from that area before marking another peak and coming down once again. And it seems like we've seen this more or less this wave throughout the last 7 or 8 months, as you can see. Now, the last time we were talking about it, it was back here on November 7th. I said that that area there was looking like a new peak of this potential fifth wave. And that does seem to be the case. But I've also mentioned in the past, the pattern does seem to be losing a little bit of its strength. And I think a lot of it actually has to do with the fact that oil, if you look at it, has been trending in a bit of a sideways trend since the beginning of September, more or less. So if we're looking at painting, let's do a rectangle just so you can see. We can roughly see that it's been keeping within the confines of this area, touching the upper and lower bound, still while maintaining this wave pattern. So it does look like it's losing a little bit of its momentum. Oil prices are finding some nice support along the downside. And of course, so far today, we have broken to a new 2022 low, as you can see, but actually momentum has reversed so far. You can see here, we're now in the green. We were dipping lower this morning, as you can see by the lower bound of the candlestick. That is when we saw that new low for the year. So it does look like we are seeing a little bit of reversal coming in. And of course, fundamentally, as I said, we have the end of the SPR releases and also replenishment potentially coming. We have China reopening. We have potentially a tightening of supply if Russia decides to stop exporting crude to the G7 countries. So we do have a lot potentially that could support oil prices in the short term. But for now, it just seems like they are stuck in this descending trend. Whenever they come close to this 92, 93 area, we are starting to see those sellers really coming in force. Now, whether this pattern is going to continue or not, it's going to depend on whether we are able to build from this area. Now, we've now actually completed the fifth wave. As you can see, we've come from the peak, attempted a little bit of a rebound, haven't managed that, come down lower and actually come back higher back here at the beginning of November. And that's when we've tested the descending trend line. Once that is completed, we've bounced off strongly. So we may just continue to see the pattern and play, and that sees a little bit of a buying rebound over the next few days, coming to within that $80 area I was just talking about, and that's where we see that resistance come back in, and then we're heading back down once again. But it's important that we build and break down below this previous low back here in September. Even though we have dipped below it, as you can see, we did it back here on the 28th and also today, we haven't actually managed to get a consistent close below it, and I think that's where the key is going to be for this bearish reversal to continue. As I said, for me, it is looking a little bit overextended. I would potentially say that it is looking like a bit of a buying opportunity in the short term before we start to see that sell-off continue once again. So watch out for that buying opportunity, buying the dip essentially, heading back towards this descending trend line and then reversing lower once again. So I said medium term, it looks like we are going to continue to trend lower, but there could be some good buying opportunities. But as I said, watch out for that SPR replenishment level between 72 and 67. Again, let's quickly mark that with a triangle. Let's see my painting skills because they're pretty poor. But roughly around this area and 63, let's say, just around here. So we could start to see potentially some support. Oh, this is poor. There we go. So we could start to see some support coming within this area if we do actually see the US replenish. I expect traders are going to challenge this area, but nonetheless, it's a good area to keep an eye out as we do potentially continue to see US crude reverse down lower after bouncing off the descending trend line. That is it for today's analysis on oil. I will actually be filming a 2023 forecast for oil prices, and that will be up on our YouTube channel in the coming weeks. So keep an eye out for that. Thank you for watching, and don't forget to subscribe to our channel.